This is going to be on the 2026 Condo Reserve and Lending Updated information by Nick Brenneman of the K7 Reserve Company. We also have a special guest today, which we'll do a formal introduction here in a minute. We have Jody Horn on today with the Fannie Mae group. So with that, I want to start. I am Peggy West. I'm your organizer, and I want to cover a little bit of housekeeping before we get started. We do record this particular webinar, and you will be sent a recording link. This is a CEU course, so managers out there, you will be receiving 1 CEU credit, and it is an IFM credit, which I know is really needed. I know for myself, I needed 1 more, so this is great. I also want to remind you to use the Q&A box for questions, not the chat box, because we do record the questions. And if anyone wants to get back to you, we will have that on record. And we are going to probably hold the questions, excuse me, most of the questions till the end of the presentation today. We are going to be sending out the slides following the class as well. So Nick's going to be very generous in providing those. And then lastly, I just want to mention that we have a sponsor sheet. For those of you who do not know, do not worry about all these introductions and writing down their names and phone numbers, etc. They will, or they might put the information in the chat box, but I will also be sending you out a sponsor sheet, and it will have everyone's contact information on it. So with that, I want to get started with our sponsor introductions, starting with Legacy Life. And tell us what you do, Dahlia, and how you help the associations.
Thank you, Peggy. My name is Dahlia Anise with Legacy Life Plan. I do estate planning.
You're muted.
I'm not. Can everybody hear me? I'm good
You're muted.
now? Okay. Okay, great. So again, Dahlia Anise, estate planning attorney with Legacy Life Plan. I just want to tell you that next week I'm having a webinar, but it's a special type of webinar. The first time doing this, because I've been having a lot of questions from people. How do we title our home in a ladybird deed or inside a trust? And there's a lot of confusion. So this is going to be a very special webinar regarding the pros and cons of both. The one thing you never do is put your adult children's names on your deed, and that we'll also be talking about why we would not be able to do that. It's a long conversation that I won't be able to discuss now, but I would love for you to join me. You will be getting an email to register for this webinar. It's on Wednesday at 12 o'clock. So thank you again, Peggy.
Peggy, you're muted.
Shawnee, can you hear me now? I'm sorry.
Yeah, we can hear you now.
Shawnee, go ahead and introduce yourself. She's with Munyon.
Hi, I'm Shawnee Haas. I'm the marketing manager for Munyon Painting. We are based here in Tampa, Florida. I don't know if you can hear the thunder that is going on currently in the background. This year, we also cover the entire state of Florida. So we have offices in West Palm Beach, Orlando, Fort Myers. So there's no corner of Florida that we can't reach. This year, we're proud to celebrate 75 years in business as a third-generation family-owned and operated company. Over the decades, we've had the privilege of painting everything from residential homes and commercial properties to high-rise buildings, condominiums, and HOA communities throughout the entire state of Florida. We also specialize in interior, exterior, and electrostatic painting, which is a special type of painting for your railings. Bringing the same commitment in quality, professionalism, and customer service to every project. We're honored to sponsor today's webinar and appreciate the opportunity to support the event. Thank you.
Thank you, Shawnee. All right, next I want to introduce Daniel Baum. He is the CEO and founder of COA Solutions. He is focused, insurance broker focused on condominiums and HOAs. Daniel, tell us about yourself. What are you doing?
Thanks, Peggy. Good afternoon, everyone. My name is Daniel Baum of COA Solutions. We specialize in condo and HOA commercial property and casualty insurance, and very proud to sponsor today's webinar. The connection between reserves, lending, and insurance has never been more important for Florida condo associations. A community may have a strong insurance program, but if their reserves are inadequate, inspections are incomplete, or the association cannot satisfy lender requirements, it can still face serious financial and operational challenges. At the same time, insurance decisions directly affect budgets, reserve planning, special assessments, and even unit owners' ability to finance or sell. At COA Solutions, we specialize in helping Florida condos and HOAs understand these connections, identify coverage gaps, and build insurance programs that protect the community without paying more for that. We also offer a complimentary policy review with no obligation, no BOR or AOR required, so boards and managers can better understand what they have, what they may be missing, and whether better options are available. Thank you all for attending. Thank you, presenters and panelists, and thanks for joining us today.
Thank you, Daniel. All right, next I want to introduce Siobhan Gonzalez. She is with United Professional Engineering. Siobhan, tell us about yourself and what's going on over there.
Good afternoon, everyone. My name is Siobhan Gonzalez. I am the Business Development Manager at United Professional Engineering. So it's a busy time of year, right? Everyone is getting ready for it's budget season. So we've been helping associations, of course, getting ready for project forecasting for next year, making sure their reserves are right. And, of course, whatever projects they have currently going on for those who are still finishing up their phase 1 inspections that are due this year. That's also been a hot topic. So if you have a need for any of that, whether it's getting your milestone completed before the year is end and the deadline is due, or you need some help with your budgeting for next year, we are certainly here to help. We are a full-service structural engineering firm. We've been taking care of South Florida condos for over 21 years. So all things for your building recertification, concrete restoration, reserve studies, and project management. Just call UPE and we will be there to help.
Awesome. Thank you so much. All right. Next, I want to introduce Best Roofing. We have Cameron Andres on today. Cameron, tell us about yourself and what is Best Roofing doing for the industry?
Good morning, everyone. My name is Cameron Andres. I do business development for Best Roofing. We're a commercial roofing contractor based here in South Florida, servicing the entire state for the last 48 years. There is no roofing project too big or too small for us. We do single family home repairs all the way up to big commercial condo re-roofs for big communities, high rises, preventative maintenance plans as well. So if you want to get somebody out there once or twice a year to come take a look. We do also offer complimentary roof audits. And as the rain continues to come down in South Florida this time of year, might be a good idea to get somebody on your roof, take a look around, take some photo documentation, timestamp pictures, make sure everything is all watertight and ready to go for the meat and potatoes of hurricane season, we'll call it. So if there's something that I can do for you, please let me know. I'd be happy to help you out and enjoy the presentation.
Okay, great. Thank you so much. All right. Next, I want to introduce Damaris Cabrera is on from Clarkson and Varick. They're elevator consultants. Tell us about the difference between elevator consultants and elevator installers.
Thank you, Peggy. Thank you, everyone. My name is Damaris Cabrera. I'm the Business Development Manager for Clarkson and Varick. We are elevator consultants. We don't touch the equipment. We are 100% and aim to be the advocate for the owners. Meaning all these contracts for the service are out there that most of the users don't understand. So many times you're going to find that you have this extra billing, and you're going to find that your equipment is failing, but yet you have a contract, so your expectation is the equipment doesn't fail. We don't touch it, but we have the ability, and the team has the knowledge to go and identify where it's failing. Is the preventative maintenance? Is the aging of the equipment? And our goal is to bring transparency to this conversation and share with the owners, so all the owners have the ability to make educated decisions, right? So we can help you if your contract is not sufficient, is not covering what it's supposed to be covering, and allow you to manage the budget, this is a perfect for today's conversation, or because you have items done on a regular basis you need to attend besides the preventative maintenance or the maintenance contract that you have that might not be covering some of the items that are aging and that might need to be taken care of on a yearly basis. Also, and this is perfect for the reserves, the elevator as a whole we consider that it's a very misunderstood asset. So it's not that the whole thing, you renovate, you do the modernization, and then you have 25 years. Technically, you should as a whole for the major components, but there are components that are gonna age earlier. And it's so important to have the understanding of these items because they can be pricey depending on the type of equipment that you have. And we go back depending on the preventative maintenance that you have. We are here to help. So if you ever have any doubts, just please, we are big on analyzing data. The data is going to always tell us what are the potential reasons why the elevators fail so often. And we do this as a courtesy to our clients to start this conversation. So please feel free to reach out. And if you have any questions, happy to help. Thank you and have a great webinar, everybody.
Thank you. Thanks for joining today. Okay, next I want to introduce Peggy Vivas. She's over the business development group for Ball Janik Attorneys. They're construction defect attorneys. Peggy, tell us about yourself and where you guys located in the state of Florida.
Good morning. Thank you, Peggy, for this opportunity. I'm so happy to be here today. I represent Ball Janik. Ball Janik is a construction defect litigation law firm. We cover the entire state. We have offices in Orlando, Tampa, Sarasota, Fort Lauderdale, in Miami. We have over 350 cases. We don't do general counsel work. We are dedicated solely to construction defect litigation on the owner side and with the property management side. So we don't defend developers. We don't work with contractors. We partnered with the people who need the property in perfect condition, how it's supposed to be. We are very unique because we provide consultative services. We can walk your property with the engineer, the expert, give you a visual assessment. We can set up phone calls, Zoom meetings. You can have a conversation anytime with our attorneys. Take advantage. It's free legal service. We are happy to do it. We want people to understand and see the opportunity to help the owners. And at the same time, we can guide you through any process, even if we don't engage with your property for the litigation. Thank you again, Peggy, and here to serve everybody anytime. Thank you so much.
Thank you, Peggy. All right, now I want to introduce what I always say is the wind beneath my wings. I have a full team partnership with Vinteum software. They are the best provider that I know about for website services for condominiums and HOAs. With that, I'm going to introduce the head of sales, international sales, and what is Vinteum doing for the industry.
Thank you, Peggy. Hi, everyone. My name is Laura. I'm the head of sales of Vinteum. So here at Vinteum, what we do is that we have a community management software. The name of it, it's Neigbrs. So what we do is that with this software, we help associations, mostly condominiums and HOAs, to have a tool or a software that makes community management a lot easier. And not only that, but helps them also be compliant, especially here in Florida, where most condominiums and HOAs require to have a website, require to have a portal or a online space, let's say, where you guys will store your documents, your meeting minutes, the information of your residents, where you guys can actually have a nice and transparent communication with your residents. So we help you guys with all of that. And not only that, but especially for those who are self-managed. And not only that, like maybe if you want to, acquire neighbors and you work with a property manager, we will make sure that you guys as board members or you guys as property managers will get a training session done by us so you guys understand how to navigate our system. And it doesn't stop right there. We have a really nice ongoing support, personalized to each one of the communities that we work with. So if any of you guys is interested on getting a community management software with a really nice, good support, we will send out our information through the chat, and I will definitely go ahead and contact you guys. Thank you so much.
Okay, thank you. And thank you, Paula, for all you do at Vinteum to support these webinars for me or for us. With that, I'm just going to run through the names of the other sponsors, and you can certainly reach out to them on the sponsor sheet following the webinar that I send out. These are all professionals that I have vetted. I've known for many years, most of them, and they are very well known, very responsible and professional in the condo and HOA association industry. Starting with Hafer Company, they're a full service CPA firm. Contact there is Nicole Johnson. The Paving Lady, they have just expanded up to Orlando now, and they're also in the East Coast on going down to Miami area. The contact there is Dawn Miller. We also have First Citizens Bank, unfortunately out on medical leave. We have Jamie Gelfand. She's doing better, though. She's a vice president and the key contact for the East Coast. And then there is Deneen Barnum on the West Coast for First Citizens Bank. We also have PD Concrete, full-service concrete restoration service company based out of West Palm Beach, Florida, primarily covering the East Coast. The contact there is the president, Daniel Pena. The president for City Quiet Windows and Doors is Ben Friedman. He's also available. Southwest Elevators, I have the state of Florida manager and one of the owners as a partner. It's a family business. They're in their third generation now. You would reach out to Brooke Cavender. So they've been around a long time, and they do work in coordination with Damaris at Clarkson and Varick. So very good team. Then I have Faster.io. Faster.io is a streaming service. It's a alternative to cable services. The contact there would be the Vice President of Community Services, Bob Aleka. And then last but not least, I want to introduce Erin Nickerson. She is the Florida manager for WRG now, based out of the East Coast, but she does cover the entire state. So when something happens, you need some service, please reach out to Erin on that list. And with that, I'm going to turn this over to our moderator for today, Jordan Kubus. He is with K7. And Jordan, I'll let you take it from here to introduce Nick.
All right. Thank you, Peggy. As you mentioned, I'm Jordan with K7 Design. Just want to say thank you. Appreciate everyone taking the time to join us today. We're definitely excited to have this one going on today, the Condo Reserve Lending Update, what CAMs need to know. So it's a topic that's been evolving pretty quickly, and today's session is designed to help separate the fact from the fiction here. We'll talk about what's changed, why it matters, and what community associations, managers, and business partners need to know moving forward. So throughout the presentation, feel free to submit questions using the Q&A feature. I know there's a chat box on the side, but Zoom has a built-in Q&A box. I'll be monitoring that, so we'll try to save it for the end, but if we see something relevant at the time the discussion's happening, we'll try to pop it in there. Just a quick housekeeping note, today's webinar qualifies for an hour of IFM continuing education credit for your Florida CAM license renewal. For all licensed community association managers in attendance, we'll take care of submitting your CEU credit on your behalf after today's session. And as a reminder, today's webinar is for educational purposes only and should not be considered legal, accounting, or lending advice. Every community is going to be a little different, so today we're talking about the lending guidelines at a high level, but when specific questions come up, it's always appropriate to involve your association attorney, CPA, engineer, lender, reserve specialist as needed. And before we get started, I'm going to introduce our presenters. We have Nick Brenneman, He's the Vice President of Sales at K7 Design, has more than a decade of experience helping community associations and developers with reserve studies, structural integrity reserve studies, and the long-term capital planning process. And we're also pleased to be joined by Jody Horn, Principal at Fannie Mae, where she leads strategy and industry engagement for condos, co-ops, and planned unit development projects. We're excited to have her share some Fannie Mae's perspective with us today. And with that, Nick, I'm going to turn it over to you.
Awesome. Thank you, Jordan. Thank you, everybody, for joining today. Excited to dive into this topic with you all, and grateful for everybody taking the time to join us. You heard the sponsor introductions, a fantastic group of business partners, all of Peggy West's efforts to put these webinars together, everything that we do at K7, everything that Jody's doing with Fannie Mae. And really, one thing that just hit me while everybody was introducing themselves is we all want the same thing. We're all trying to achieve healthy, sustainable, and successful communities. And the way we do it just looks a little bit different. And that's what K7 wants. That's what Fannie Mae wants. And so you're in good company because we're all on the same team here. But before we talk about reserve studies, reserve funding, or Fannie Mae even, I want you to imagine something. Imagine a young couple buying their very first condominium. They've saved for years. They've toured their properties every weekend, so excited about what the future holds. And they finally find the perfect place. The inspection looks great. Their budget, their income looks good. The association is beautiful, and everything appears ready to close. But then the lender reviews one more thing, the association's finances. And suddenly the loan is denied. Not because of the buyer, not because of the unit, but because of the association's reserve funding. 5 years ago, that story would have surprised most people. But today, it is becoming increasingly common. The reality is that today's reserve decisions shape tomorrow's buyers. And that's really why we're here today, because reserve studies are no longer just about planning for roofs, pavement, or elevators. They're becoming part of the financial health of an entire community. They influence lending, property values, marketability, and ultimately the people who are able to call these communities home. Which raises an important question. If reserve funding now affects lending, then how do we know what's enough? How do we determine what a community actually needs? Where do these numbers come from? And that's where reserve studies enter the picture. I like to think of reserve studies this way. Reserve studies don't predict the future, but they prepare communities for it. A reserve study at a very high level is an engineering-based planning tool that helps boards understand what do we own, what condition is it in, and when will it likely require replacement. And at what rate should we be setting aside funds today so tomorrow doesn't become a financial emergency? The reserve study really can be broken down into two main parts, the physical analysis and the financial analysis. The physical analysis answers the question, what do we own? So we're looking at all of the reserve components, identifying what are the components, what are their quantities, their measurements, their remaining useful lives, meaning when will it wear out, based on the age, but not just the age, also based on the observable condition. So an engineer is going to be on site assessing the condition of those components to determine a realistic remaining useful life. It's important that we look beyond the age because, you could have a component that's young but hasn't been well maintained or had particularly rapid deterioration based on a number of other factors, and compare that to an older component that's been lovingly maintained with preventative maintenance over the years, and you can to extend its remaining useful life. So it is much more than age. It is the observable condition that's a key factor in that physical analysis. Then the second part is the financial analysis, which is really what is our current health when it comes to reserves. And what we're looking at is all of those inputs from the physical analysis. What components do we have? The quantities, the measurements, when they're going to wear out, and what the future costs are going to be. We need to offset those with a funding plan that's going to identify when the funds are needed and make sure that they're going to be available when the time comes. And so that is the financial analysis. It's basically where do we need to be and how are we going to get there? And the how are we going to get there part is the funding plan. And this is a very important topic to understand, especially in Florida, given all of the focus on reserves, the statutory requirements, and now adding in the Fannie Mae lending guidelines to the mix. Reserve funding is critical for board members to understand if they really want to be good stewards of their association and fulfill their fiduciary duty. So I'm going to try and break this down in a way that's easy to understand, especially if you're new to the topic, so that you can leave here with a better understanding of these reserve funding. There's really imagine three personalities sitting around every board table. All right. One says, I want the lowest assessments. That's baseline. There's a funding plan for you. Someone says, you know what? I want balance. That's threshold. And then there's another board member at the table who says, you know, I want maximum predictability. And that would be your fully funded. So we're looking at baseline, threshold, and fully funded. And there really isn't one right answer. Every community has to balance risk, affordability, and long-term sustainability. But let's start with baseline funding. This is the minimum funding objective. So the goal of baseline funding isn't to accumulate a large reserve balance. It's simply to avoid running out of money. And when we look at baseline and threshold funding, those are cash flow funding plans. What I mean by that is we look at all of the reserve components at once and identify the expenditures, the projects, the costs that are coming up. And then the funding plan for a cash flow analysis offsets all of those expenses with stable, adequate contributions to the reserves over time. So it's not necessarily a one-to-one approach like a straight line component method reserve calculation, but it's more kind of balancing the cash in and the cash out over time, making sure that in the horizon of the projection, which generally 30 years, our reserves never fall below a certain level or get to a certain level. So when we're talking about baseline funding, I liken that to like driving on empty, because all we're trying to achieve in baseline funding by definition is to keep the reserves at or above $0. So it really is the absolute bare minimum. You have a higher risk level, because if you think about it, if the analogy is driving on empty, maybe mathematically it works, but real life happens, right? And we all know that unpredictable things happen. Everything doesn't go always as planned. So, you know, let's say your gas light comes on and your dashboard tells you have 15 miles till empty, and you're following Waze or Google Maps, and it says you're 15 miles from your destination. So you're like, all right, we're good. Mathematically, we're good. But who knows what's really going to happen in those 15 miles with the way that the car is going to work, with the type of gas that you have, how accurate the navigation is. That's an illustration, but I think it kind of hammers home this point that if as long as you're mathematically good, if you're cutting it too close, real life could create some problems. And what that looks like in the reserve world is maybe projects need to happen earlier than we predicted, and now we don't have time to get those additional funds. Or maybe some costs are coming in higher than what we had anticipated, and now we have a shortfall for some of the upcoming projects. So to take that a step further, if you want to build in that margin of error, what boards do is they follow what's called threshold funding. Threshold funding is like maintaining a safety level. So we talked about baseline funding is this cash flow analysis, 30 years, making sure our reserves never fall below a certain threshold or a certain point. In baseline, it's 0. In threshold funding, we build in some sort of margin, some sort of cushion that's a predetermined threshold where we say the idea being we'll never allow the reserves to fall below this number, this balance. And that is the objective of that methodology. That's how we design a threshold funding plan, is we look at those years the reserve gets really low, which are often years of major projects. And we actually have a name for those years. We call them critical years or threshold years. So we look at those threshold years and we say, all right, let's keep our reserves above this predetermined threshold. So that's a cash flow strategy. The size of that cushion, the size of that threshold depends on the specifics at your association, what your budget looks like, the association's objectives, and the risk tolerance. That's going to be something that you work with your reserve provider to determine what's appropriate. It's definitely not a one-size-fits-all approach. But the objective of threshold funding isn't to have every dollar saved today. It's to ensure the association always has sufficient cash available when it needs it. When I say fully funded, that's the third strategy we're going to talk about today. That answers an entirely different question. It isn't asking whether we'll have enough cash to pay for future expenses, but it's asking whether today's reserve balance matches the deterioration that's already occurred. So you think of a roof with a 20-year life. If it's halfway through its useful life, then roughly half of the replacement cost should already be accumulated in reserves. That's how we measure the fully funded balance. Fully funded doesn't really look at the context. It ignores future reserve contributions, interest earnings, future study updates, simply measures how much of each component's been consumed and compares that to the reserve balance today. A good way to look at this with the gas analogy is fully funded is like saying you always have to have your tank full. Threshold funding is more like, well, we don't need to have a full tank because we know we can stop at another gas station. Gas stations being more contributions to the reserves, interest that we're earning on those accounts, future updates to the reserve study. There's ways that we can course correct. There's ways that we don't need to always be sitting with a full tank. We don't need to always be sitting at the fully funded balance. Another way to say it is, threshold funding is really a way to optimize your reserve funding because we're achieving stable, equitable reserves, but we're also exploring the minimum balance that's required. A lot of times, more often than not, a fully funded strategy is going to require higher balances and higher contributions to the reserves, which is why threshold funding is, many professionals' recommendation and what a lot of boards have chosen to adopt. One important point is that these funding objectives aren't about right or wrong. They're just different philosophies. And that's exactly why Fannie Mae recognizes threshold funding as an acceptable methodology, because their concern isn't whether an association is 100% fully funded. Their concern is whether the association has a credible, developed funding strategy that supports the long-term health of the community. So everything that I've discussed so far answers one question, really. It's how should communities plan? Now let's answer a different question. How are lenders looking at these decisions? And there's really no one better to explain that than Jody Horn from Fannie Mae. One thing before I introduce Jody and turn it over to her is in Florida, we've navigated a lot the last few years when it comes to community associations, condo associations, and a lot of changes, legislative changes, statutory changes. And it's been a wild ride, if we're being real. And there starts to be like this cycle that I've noticed, this pattern, which is, something new is going to come. We hear about it through the grapevine. People start talking about it. And then we find a source, we find some language. And then we start to figure out what is it, what isn't it. Everybody's trying to sort through fact from fiction. There's a lot of misinformation out there. And then finally, we get to a point where, okay, the dust has settled and everybody really knows what it means. what the requirements are, and now let's move forward and guide our associations. And there's been one thing that's made a huge difference every single time, and it's going right to the source of truth. And with the legislative stuff, it's like, man, I want to hear it from an elected official, exactly what the intent was, exactly what that language means in that bill. And we can kind of cut through all of the misinformation, find out the facts straight from a source of truth, and continue to serve and guide our associations in the best way possible. So that's why I'm so excited to have Jody here today, because, as a representative of Fannie Mae, she really is the source of truth, and we can hear it straight from the source today, separate fact from fiction, and serve our association. So Jody, thank you for joining us. Really grateful for all that you're doing for community associations. Like I said at the beginning, we all have the same goal. It's to support healthy, sustainable, successful communities. And also, I take that a step further, probably with Fannie Mae, is healthy, sustainable home ownership. That if people are going to buy into these homes, we want them to be successful, have a successful outcome with the loan and what home ownership looks like to them. So I guess maybe just starting off, Jody, for anyone unfamiliar, what exactly is Fannie Mae?
Yeah, thanks, Nick. And I appreciate that question. And before I dive right into that, I just want to thank you for having me as a guest in your webinar today, and to thank Peggy for the same. Really happy to be here, and even more happy that all of you are here, because this topic is so important. And as Nick said, at Fannie Mae, we're not just concerned with the community being healthy, which we are. We are absolutely concerned with sustainability for condo communities. We're concerned about the homeowner, and that their homeownership journey is a successful journey. And so a lot of what we'll talk about today is about this question of sustainability of the community and sustainability of the homeownership journey. Fannie Mae plays a unique role in the industry. A lot of times folks think Fannie Mae is a mortgage lender, that a consumer might go to Fannie Mae and get their loan. That is actually not our role in the industry. We're in what's called the secondary market, or the secondary mortgage market. And what that means is we buy mortgages from lenders. The lenders, actually the mortgage bankers, they're the ones giving the loans to consumers so they can buy their unit in the condo project. Then they sell those loans to Fannie Mae. And they do that because that frees up more money at the local bank level, so that they can continue lending more loans or more mortgages to consumers. And so we play a really important role in buying up all of those mortgages, and then we package them up into investment securities and sell them to investors. And that keeps money recycling through the mortgage industry for consumers. And it's a pretty big business. Nick has some numbers up here on the screen. In 2025, so last year, we provided over $400 billion in liquidity to the housing market. We've supported 1.5 million households, American households. And we have a really big book of business, 4.1 trillion. It's hard to imagine. But as part of this work that we do to buy up these mortgages so that we free up capital for more mortgages to be made, is we set standards for lenders. So when they're selling us those loans, those loans have to comply with our standards. And if any of you have gotten a mortgage, you know that a mortgage banker is going to look at your credit score. They're going to look at your debt, your liabilities. They're going to make sure you are a good credit risk. They're also probably going to get an appraisal to make sure that the value for the home or the condo unit that you're purchasing is supported. And if it isn't a condo project, we have another set of standards, which we'll be talking a lot about today. And that is the requirements that the condo project itself meet our eligibility requirements. And there are a lot of different eligibility requirements. And today we'll be focused mostly on budgeting and reserving. But they're also looking at things like a single entity ownership. So how many people, how many single entities own blocks of units in a condo project? Big topic in Florida is condotel type behavior. So is this project operating more like a resort condotel or short-term vacation rental project? That could create some eligibility challenges. Insurance, huge topic for condo eligibility. So there are a lot of different eligibility requirements we're looking at for the condo project itself, in part because the operation of the condo project helps set that homeowner up for long-term success in their home ownership journey. So really important to understand just some of that background before we dive into some of the details.
Yeah, that's great information, Jody. This next slide, I think you can definitely provide some background why the standards have changed. So we all know that there's change that's happening right now as we speak. Just a few days ago, there was a change and another one on the horizon in January. Maybe you could just talk to, when underwriting a condo, what are the lenders really evaluating and why these changes made sense, and why they're appropriate.
Sure, yeah. So as I mentioned, lenders are evaluating lots of different things at the condo project level. In fact, depending on the complexity of the project, they may be looking at 60 or 90 different things. And many of you have probably seen condo questionnaires. Lenders aren't just sending you that because they've got nothing else to do in their day. They're actually sending you those documents or asking you to complete those documents and asking for budgets and other kinds of things because they are doing this underwriting to determine that the condo project is eligible. And so we did make changes. We announced them on March 18th of 2026 in a lender letter. Those changes, by the way, are aligned with Freddie Mac, which is another similarly positioned company as Fannie Mae. And those changes focus on reserve funding, reserve studies, and insurance primarily. There are some other changes, but you can certainly look at the details in that lender letter. But the real reason why we have made these changes in the marketplace, especially around reserves, is to support that long-term sustainability. As Nick and others have already talked about on this webinar, sustainability isn't a one-time thing when we think about condo projects, but it is a long journey. And every day there are things that each of you are managing in the communities that you support to maintain the project's finances and maintain its physical condition. And we know from all of the work that we do on our end and looking at condo projects, that if the condo project is not well reserved, is not taking care of itself from a financial perspective, there's a very high likelihood that it's going to run into physical deterioration pretty quickly. And I know in the Florida market, you all have probably seen newspaper articles about condo associations that are facing the difficult challenge to potentially have to dissolve the condo association and sell off the assets because there has been such physical deterioration that the unit owners don't have the funds on hand and can't access the funds to be able to take care of the repairs that are required. So we always want to see that condo projects are set up for that long-term sustainability so they avoid deferred maintenance and critical repairs. And then ultimately, this does protect individual homeowners. Maybe you're in an association that says, well, we don't want to do all this reserving. We'll just special assess when we need to make a repair. And that may be fine for maybe you or maybe some of your neighbors. But there are others that live in your community that will not be able to afford that large special assessment. And ultimately, that will have an impact not only on them and their own household budgets, but the successful operation of that community, because the community itself will have a challenge in raising funds. So that's the broad context for the changes that we're going to talk about today, Nick. Really keeping in mind that long-term sustainability, and that's what we'll come back to again and again.
Yeah, that's great. Speaking of the special assessments, not only is it a financial burden, but it's also not equitable. When we're doing reserves right, it's equitable contributions. You pay your fair share. The special assessment, you're paying for that entire component's replacement, even if you just moved in there, paying for someone else's long-term use of that component. So
Yeah, and Nick, I loved your analogy of the gas tank and the driving, because I have a similar analogy around the reserving practice. We've all driven on toll roads, toll highways. Why are they charging the toll? Well, they're charging the toll because the expense for that wear and tear is happening as your car is driving down that road. So it's collecting some marginal or incremental amount of money to put in a pot so that that road can be maintained over time. And I think about reserves in much the same way, right? It's not that suddenly there's this work to be done, but rather that wear and tear on that building and on the amenities of that association have occurred over time as the residents are living in that building and enjoying the use of all of those amenities. And so just like a toll road, reserves collect that money over time to put it in the bank so that when it's time to do those repairs, it's there.
I love that. That's great. And could you imagine if you pull up to a toll you're used to going to every day and they make you stop? It's like, oh, you just happen to be here at the right time. We're actually redoing all the roads and we need you to write a check for it. Just doesn't make sense. And that's what really the special assessment is. Yeah, that's a great way to look at it. Jody, what specifically changed this year? I know one of the big things is this retirement of the limited review. Do you mind just walking our attendees through what that means and
Sure.
how you guys are handling that?
And so there are different review methods that lenders are able to use to determine condo project eligibility for Fannie Mae lending purposes. And Fannie Mae actually does a lot of reviews of condo projects. We have thousands and thousands of condo projects where we've done the review and for the most part have determined that they are eligible. The one thing that lenders have been able to do in the past is a limited review, and I'll juxtapose that to a full review, which is now the more standard requirement or standard review process that they'll be using. A limited review, which we retired with new loan applications this week on Monday, was a review process that is by and large mostly consistent with what is left in its place. The difference between the limited review and the full review from a lending perspective is that in the limited review process, we waive the requirement to look at the project's budget and reserves. Again, if we're thinking about that long-term sustainability, how much sense does that make that we're waiving the review of the budget and the reserves? That's like one of the most critical things. So we retired that limited review process so that in the lender delegated underwriting practice, they are getting they are looking at the budget, they are looking at the reserves, they're looking at dues delinquencies. So they're looking at these key fundamental facts of the project's financial health when they are doing that review. And this mostly applies to larger projects. If the project has 10 or fewer units, or if the project is just detached units, so fully detached, they're eligible for a different process called the waiver of review. But most projects are more than 10 units, and most are going to be attached units. And so when a lender's doing their own underwriting of the condo project, they will be looking at that full review process, which means they'll be asking for a budget, and they'll be asking to understand or seeking to understand that the budgeted reserves and other things on that budget are in compliance with our requirements.
And that's going to be a major change. Something new is the lenders looking at those financials, whereas before they weren't even asking for it when it was going through that limited review process. Let's talk about there's a lot of talk about this 15%, 10%, 15%. Can you tell us about that and what the reserve funding expectations are currently and what they're going to be changing to and when and what that all means?
Sure. Yeah, sure. And this is really maybe the most important thing we talk about today with respect to our lending changes. So I just mentioned folks are going to be looking look to make sure that the project is budgeting at least 10% of its annual assessment income for replacement reserves. This is a budget test. This is not a money in the bank test. I've already seen some questions in the Q&A panel saying, well, how, do I have to fund this? What does this mean for funding? From a lending perspective, a lending eligibility perspective, and that's what I'm talking about here. This is a budget evaluation. Is the association planning to reserve at least 10% of its annual assessment income, and that's regular assessment income, for replacement reserves. And when they're looking at that, they can make certain exclusions because, again, we're looking at that regular assessment income. So say special assessments, income related to that can be excluded from the calculation. In January, so with new loan applications in January, and this is really important, that 10% increases up to 15%. So the calculation changes. They're looking to confirm that whatever the budget says the association is reserving, that is at least 15% or more of the annual assessment income. This is so important because for many of the associations that all of you support, this is prime budget time, budget planning season right now. So this is the time to be having those conversations with your HOA boards and the HOA members to help them understand that this change is going into effect, and it will be in effect for new loan applications beginning in January. If you plan for, maybe thinking about this in January, chances are it is too late. That means loans in your community may be denied if you do not meet that 15% requirement in January. Now, Nick, one of the things folks ask a lot is, well, what if we're not reserving that much? Or what if we don't need that much? And that may be true. If you have a reserve study by an independent third-party professional, and it's within the last 3 years, and that reserve study suggests that you need to, in today's world, less than 10%, but starting in January, less than 15%. Maybe your reserve study says you only need to be reserving 8% of your annual assessment income for reserves. The lender can use that reserve study as an alternate method to confirm financial sufficiency. But when they do that, that they have to be confirming that the association is reserving to the highest recommended funding method in the reserve study. So when we think about those 3 methods you just talked about, if that reserve study represents a fully funded amount, then the association would have to be reserving in accordance with that fully funded recommendation. The other thing they cannot use is baseline funding. And that actually, that change went into effect, again, with new loan applications on August 3rd. So that's Monday, this past Monday. They can use that reserve study to justify a lower amount, provided they're not using baseline funding and they are using the highest recommended amount in the reserve study. And again, I loved your analogy around baseline funding and kind of trying to stretch that empty gas tank to get to your destination. We often talk about it here as living paycheck to paycheck. When you live paycheck to paycheck, if your refrigerator breaks, well, there's no money in the bank to fix it because you just don't have it. And just like a household budget, we would not want you to live paycheck to paycheck. We would not expect a condo association to be living on such a thin margin.
Yeah, that's great information. just a couple things to add. I don't think we made this clarification, but it's important. It's not just new purchases that are affected by these eligibility guidelines, but it's also refinances too. So if there's an owner in a condo project that wants to refinance, they have to meet these, your association has to meet these requirements as well. And
that's exactly right. And it potentially impacts any mortgage transaction.
And the other thing, and this is Florida specific, but it's worth noting, and I asked you of this, and we had to kind of look at the details, but we can kind of set the record straight, is in Florida, we have this unique situation where we have statutory language related to the structural reserve study, whose funding requirements don't necessarily align with the lending guidelines that Fannie Mae is putting out. And so as Floridians in condos, we have to reconcile that. We have to understand that. So for our audience today, how do we wrap our heads around that? What Jody shared with me is that, and feel free to chime in too, but that the Fannie Mae lending guidelines, it's a national program, and it's not the law, but it's a lending guideline. And so just by meeting the law in the state of Florida does not necessarily mean that you are going to meet the lending guidelines for a national program from Fannie Mae. They don't align. They don't necessarily need to. And as of right now, they don't. This is important because the statutory language for the SERS, the structural funding, says that baseline funding is statutorily approved, that you're compliant if you baseline fund according to your structural reserve study. So one important thing to know is if you are baseline funding your reserves, that's going to be a problem with Fannie Mae's national guidelines, even though it does satisfy Florida. We have to think beyond that and set our communities up for success. And part of that is not only being compliant with the statute, but being able to do business as a community, buying, selling, refinancing. The other thing is go ahead, Jody.
I was just going to add, Nick. So it is right, and we do require compliance with state law. So there are in Florida a number of state laws related to condos and how condos are managed, and so lenders are required to confirm compliance with state law. But sometimes our lending requirements go above what the state law sets as a threshold, and so in this case, we would require something more than that baseline funding related to a SERS in the state law. Yes, we require that compliance, but then we also require the lender validate what we're talking about here as well.
Yeah, that's great. And then the other thing is that some associations that need the structural reserve study, letter of the law identifies just a handful of structural components that need to be in a structural integrity reserve study. But there's a lot of other reserve components that an association is responsible for that is not in a SERS, that doesn't have statutory obligations to fund according to that study necessarily. And so for the associations that only have SERS funding, so you got a SERS only reserve study that only looked at those structural components, Fannie Mae would not consider that a reserve study. They would be looking for a traditional reserve study in the sense that it's all encompassing structural and non-structural. Is that correct, Jody, too?
That's correct. So if you think about a lender process, they're always going to go the happy path first. And so if your association today in the budget is planning to reserve at least 10% of its assessment income, and that's evidenced by the budget. And then in January, 15% of the assessment income is being planned to be in reserves. That's where the lender is going to stop. They're usually not even going to ask for that reserve study for this purpose, for determining budget sufficiency or adequacy. They're just going to look at the budget. But when they are looking at the reserve study, because your budget does not evidence today 10% and tomorrow 15%, then they're going to be looking at that traditional reserve study, because again, they're looking to understand that that project is sufficient or in terms of the financial management, and that it's going to be sustainable over the long run. And the Florida Structural Integrity Reserve Study, while really important and an important piece of information, it doesn't have all of the other components that the association is responsible for maintaining, which speaks to the broader financial health of that condo association. So for the purposes of our lending program, they are going to be looking at that more traditional reserve study to demonstrate financial sufficiency when the project is not meeting that basic budget requirement.
Thank you for explaining that. It's helpful to kind of understand the steps they take. Like you said, the happy path first. As long as you hit that percentage, no one's even cracking open a reserve study.
They are not, unless, and so there's one caveat, and I'll mention that before we go into this example. Sometimes lenders are trying to understand the physical condition of the project and whether or not there are a significant deferred maintenance or critical repairs. And if they're unable to get an inspection report or other information to understand that component or that piece of underwriting, which is a different requirement that we have that we're not really digging into today, they may ask to see the structural integrity reserve study or the regular reserve study or both, because they're trying to confirm that there's no significant deferred maintenance, there are no critical repairs in the project. So even though if the budget is sufficient, they may not look at the reserve study for that. They may be looking and asking for the reserve study for this other underwriting requirement that they're seeking to validate. So I want to make sure that folks know that if a lender's asking for a reserve study, there's a good chance they're trying to get a question answered for underwriting and eligibility purposes.
Thank you for that distinction.
Yeah.
So like you mentioned, associations, the majority of them are starting to have budget conversations, and with January being when the 15% kicks in, do you mind just walking us through an example of how to calculate what that percentage lands at in their own association?
And this is just a super simple example. All of you are managing budgets much more complicated than this, but to illustrate how a lender might look at this, and I think this example does do that well. We have a total income for this project at $1.1 million. We have $900,000 for the regular assessment, and we have some incidental income and some utilities income, both of which can be excluded from the calculation. And then we have the reserve contribution here of $150,000. And as I mentioned previously, we do allow certain things to be excluded, like the reserve contribution, incidental income, and utilities income that's passed through. So in this case, a cable internet contract, that's typically something that a consumer would pay, and so we consider that pass through. All of those things are allowable exclusions in our selling guide, which by the way contains all of the Fannie Mae lending rules. So in this example, if we do that basic calculation comparing the $150,000 to the $1.1 million, we get a reserve calculation of 13.6%. Now, in today's reality, with that 10% reserve requirement, with no exclusions, this project meets our basic reserve requirement. And so it would be eligible. But come January, when that increases up to 15%, just doing a straight line calculation, comparing the total assessment income versus the reserve contribution, it falls a little bit short of that 15%. And so that's where lenders can make certain exclusions. They can exclude, like I said, the incidental and the utilities income that that are provided there. They can also exclude the reserve contribution. They can exclude special assessment income, as well as income that's passed through to, say, a master association. Some of you manage projects where there's a large master association and then there are sub associations. So they can exclude some of that income as well. Once you account for those exclusions, redo your calculation. Now you're only taking that $150,000 by the $900,000, and then we see the reserve contribution there is 16.7%. That meets or exceeds our 15% minimum threshold, and so then the project would comply. Now, Nick, I would just add one note of caution, because I know you have some really smart people on the line today that manage communities all over the state of Florida. What we're talking about here are lending requirements. What is the minimum amount an association would have to do to meet Fannie Mae's reserve requirements? And as you noted, associations might actually need more. If they're looking at a reserve study and they're reserving in accordance with that reserve study and doing the maintenance as recommended by the reserve study, they may see that the association should have more than Fannie Mae's minimum requirement of 10% today or 15% tomorrow. We want to be clear. These are our basic lending requirements. So at a minimum, we expect 10%. In January, that goes up to 15%. But associations would do well to look at their reserve study and base their budgeting off of a reserve study, which may mean, to really fully meet their needs, they might need to reserve more than the Fannie Mae minimum that we describe here. That doesn't mean that if, say, they're reserving 15% in their budget and their reserve study says they need to reserve 35%, and maybe right now the association is only reserving 20%. So the association is splitting the difference between what our requirements are versus what the reserve study says. We're not asking lenders to look at the greater of the two, right? So even though our requirement is 15%, the reserve study says they're reserving or should reserve 35, but they're actually reserving 20. 20 meets our requirement. So from a lending perspective, that requirement is satisfied. Even if the lender looks at that reserve study and says, oh, I see here the reserve study says 35%. It's okay. From a lending requirement perspective, that they're meeting our requirement, that's not going to hold up mortgage eligibility for this purpose, if that makes sense.
Yeah, that makes sense. And that's a really helpful point. Thank you for adding that.
Mm-hmm.
Question for you, Jody, maybe you can speak based on your experience. So if I'm a board member, even a manager for that matter, and I'm looking at this calculation example, and I'm starting to see what's coming down the road in January, that there's going to be some adjustments. Maybe we're not even at the 10%, and we're doing this as long as I've reserve funding is there's a culture that every community, every association has, and that's a tough thing to break. Over time, they kind of get set in their ways, and new board members, new managers with great intentions come in, and it's an uphill battle sometimes to start taking steps to changing the way things have, quote, always been done. How would you approach having this conversation with the owners about the adjustments that we need to be making? Because I think that a lot of it has to do with the delivery. Not what you say, but how you say it, how you frame it. It's probably not going to be the most strategic to say, well, this is what Fannie Mae is making us do, so we're going to increase all of the assessments. I think that boards can do better than that. Do you have any advice on how to have this conversation if there are adjustments that are coming, if there is a change in the way things have always been done to, kind of a new way of thinking?
That is a great question. And I do think that's going to, managers and HOAs are going to have to, in some ways, figure that out for each specific association. As you know, They all have their own culture and their own ways of doing things, right? But I agree. Just simply saying Fannie Mae's making us do this, or Freddie Mac, for that matter, is making us do that. That puts the association in the role of a victim, right? Nobody really wants to be a victim of their circumstances. I would, in my mind, trying to reframe that in terms of what kind of an association do we want to be? What are the goals that we want as an association? And then how do we achieve those goals? That puts the power in the hands of those board members and of the association members. And so I suspect that most of you are managing associations where nobody would say, we want to live in the most rundown place where every time something breaks, we have to special assess and we have no control over that. We're just kind of, hoping, knocking on wood, buying our lottery ticket, that, a bad thing won't happen because we're not prepared. Nobody wants that. And nobody wants to be in a situation where, gosh, I have to sell my unit, or I want to sell my unit. And now I'm limited in terms of who can buy because I can't, the buyers who are interested in this can't get mortgage financing, right? Like, is that the association you want to live in? So I would always start there with what are our goals? What kind of community do we want to be? What do our professionals tell us we need to get there in terms of, what kinds of reserving needs to come into play? How do we need to maintain our amenities? And then start from there. My guess is if you start from that angle and you look at who do we want to be and what kind of community do we want to have, maintain, and build, you're probably going to get to answers that would support a higher reserve amount than even what Fannie Mae is recommending here or requiring here. Is that helpful
I
to
love
think
that.
about it from that perspective?
I think that's great. I think that's a great approach is, what is the reason that we're doing this? And looking at, the choices that we make are going to determine what type of community we're living in, and the opportunities that, we have available. And that kind of goes, into the next slide, which is kind of like the domino effect, as I call it. But I want to just add one point that you made a few times when we were talking as we were putting this presentation together. And it's that condo boards don't do business at the same pace as the lenders. And so if you can't wait until, a loan is denied to go, we need to contribute more to the reserves, because everything in the lending world happens very quickly and everything in the condo world doesn't happen at that same pace. So this is something that you really have to plan for ahead of time, see the writing on the wall, that those phone calls, those denials are going to be coming inevitably or eventually, and that now is really the time that we start preparing for those, not when, the lender denies the loan, because
That's
at that point,
100%.
it's going to be way too late to do anything
Yeah.
meaningful about it.
The average lender, when there's a loan application, depending on the type of transaction and some other things, often, that loan may close within 30 or 60 days. Boards are looking at their budgets typically to approve the budget once a year, right? And so, you don't want to wait until, there are loans at stake and people either can't refinance or sell their unit because mortgage financing is an issue. And Nick, the other thing that comes up often as I'm doing a number of these engagements is a lot of folks think, well, our units sell for so much more. And so we're never going to need Fannie Mae loans. Well, the truth of it is Fannie Mae and Freddie Mac make up a significant portion of the residential condo mortgage market in terms of the loans that we purchase. And don't assume that if you have a high-priced condo building where things sell at very high values, that loan won't come to us, because very often in a refinance situation, the owner has significant equity, so their loan amount is lower than the value for the unit. Or even in a purchase transaction, people will bring a lot of equity, or not equity, but a lot of funds to that transaction so they can have a lower loan amount, so they can get access to a loan that is intended for sale to Fannie Mae or Freddie Mac, because the loans that come to us tend to have lower interest rates than loans that go to private investors. And even if that loan were going to a private investor, so it's not intended for sale to Fannie Mae or Freddie Mac, we are hearing in the market that a lot of private investors and others that hold these loans on their portfolio are leaning heavily into our requirements. So they often follow suit in terms of our requirements, even if those loans don't come to us.
Yeah, I remember you sharing that with me. I thought that was really important, that, you know, even if Fannie Mae is not directly involved in a lending situation, that you guys kind of lead the way, and a lot of the other lenders look to you, and the things that you look at for underwriting, they start to incorporate those same practices as well.
They do.
So I don't think we necessarily need to elaborate too much on this. This is just kind of the changes so far. There was, you know, the retirement of the limited review just a couple days ago, and baseline was retired. And then the big change, which we've talked about extensively, is on January 4th, that the reserve benchmark goes from 10 to 15%, as we showed,
That's
you know,
right.
with that calculation example. Oh,
And
go
Nick,
ahead.
before you jump over, just a quick two things that I'd want to say here. One, again, this is not a money in the bank test. We've heard that folks are thinking, well, we've got to special assess so that we can comply with Fannie Mae requirements here. No, there is no need to special assess to comply with this requirement. We are simply looking at the budget and comparing what you're budgeting in for reserve contributions compared to your budgeted assessment income. So I want to clarify that myth. No need to special assess just to meet this requirement. You may need to special assess for other reasons, but this would not be it. And then the second thing that I would just add is, again, a plug for looking at that March 18th lender letter. We made a ton of changes for insurance, many of which make insurance more affordable and easier. And I think that will be of significant concern or interest, not concern, to your audience members today. So definitely take a look at that lender letter for that additional information. And it was dated March 18th of 2026.
Yeah, excellent. Yeah, major changes on the insurance side too that we just don't have enough time to get into today. So if we kind of look at the domino effect, you know, everything is all related. And so, like when Jody said, what community do we want to be? What type of future do we want for this association? The reserve planning really does dictate the building condition. Because if we have healthy reserve funds, we can do the projects when they need to be done. Things are standing tall. Things are things are structurally sound. And excellent building condition creates buyer confidence, which also unlocks that financing availability. So then we are ensuring the highest level of marketability for our condos, which protects the property values. So you can see that, you know, healthy strategic reserve planning ultimately will lead to healthy property values. And that's a direct correlation. And these are kind of the things in between and the dynamics at play. But it is much more than just eligibility for a lending guideline when we're looking at reserves. It's setting our associations up for long-term financial sustainability and health. So as we close, just a few like forward-looking things, some tips and some things to be thinking about for those that are here today. Maybe, you know, start assessing. So which lending requirements apply to your specific community, reviewing your current reserve study, and comparing your proposed budget or the one you're putting together now with the 26-27 lending benchmarks from Fannie Mae. Consult with professionals. You know, we mentioned that there's a lot of insurance changes. Consult with your insurance professionals, reserve professionals, legal, accounting. we spent a lot of time before we started introducing some awesome partners and business professionals. That's going to help achieve success, is surrounding yourself with people who can give you great advice. Organize your documentation, whether it's, capital projects, budgetary information, anything like that. You just kind of want to have your ducks in a row, have everything in order, especially now that the limited review is retired, and it's going to be more commonplace for a lender to ask to see the financials. Just make sure that stuff is readily available and in order, and communicate potential budget changes to owners early to preserve confidence. This is something that you don't want to wait till the very last minute. It's not practical because lending timeline is very different than condo timelines, as we talked about. But also how we say it, when we say it, is a huge part of being effective at having effective conversations and being successful at setting our communities up for success and making these changes when they become necessary. I would like to leave you with 5 questions, and you don't have to answer them out loud, but just answer them in your mind for the community you're thinking about today. If you find yourself answering no or I'm not sure, then it might be time to take another look at your reserve study, because this is going to be an integral part to setting up your community for success. Number 1, how old is our reserve study? Reserve studies aren't meant to last forever. So many communities follow a 3-year update cycle. That is CAI's best practice that they recommend. And that's because communities don't stand still. Life is happening, things are changing, the market's evolving, things are happening physically on site. So that would be the first question I would ask. Fannie Mae, if it gets to the point in the review process that the reserve study is being taken into account, they require that study is within 3 years, which also aligns with CAI's guidelines. Second question is, does it reflect today's replacement costs and market conditions? So we know construction costs, labor, materials have all changed dramatically over the last several years. Even a technically accurate study can become financially outdated. So, if you're looking at the projects that are coming up, are those costs still reasonable with what we're seeing in today's market? Has our community changed? Have you completed major projects? Have you added amenities? Have you replaced components? Your reserve study should reflect the community you have today, not the one you had several years ago when the reserve study was completed. So just make sure that it still aligns with reality. Does our funding strategy still align with our goals? So funding strategies can and should evolve with the community's position and long-term objectives. So as your community evolves, so should your funding strategy. What was appropriate for recommended funding years ago may not still be the same level that's needed. And this is my favorite one. Would we feel confident if a lender reviewed it today? When you think of handing your reserve study to a lender, how do you feel? Are you nervous? Are you excited because this is a great study and we're following it and we believe in it and we've got a great professional helping us? Reserve planning is no longer about just maintenance. It's part of the financial story your community tells to lenders and potential buyers. It's not a report you file away, a planning tool that should evolve with the community. So these questions really serve as just a reminder of what a reserve study is supposed to provide, not just a spreadsheet or a report, but really confidence that your community understands where it is and has a plan for tomorrow. Jody, you mind just real quick telling folks about these resources available?
I will try to be fast.
I know,
and we have a lot of other resources on our website too, but I think these are maybe the 2 most important for this group. I've seen some questions around or comments around a project not meeting our requirements or not being eligible for Fannie Mae. If you have heard that about a community that you're working with as a property manager, or if you're an HOA board member and you're wondering if your project is already ineligible for Fannie Mae for one or another reason, this Condo Status Finder is a great tool. You go in, you can follow this QR code. It will you can set up an account, and then as the HOA board member or the authorized representative of the condo community, you can type in the information for that community and find out if the project is ineligible. We will tell you the reasons we have or on file, so the information we know about the project around that ineligibility status. And most importantly, it gives you access to a link to connect with our team directly so that you can submit updated documentation to resolve any issue that may be found there. So definitely a great resource, something that you should bookmark. And then the other resource here is, I know there's been a lot of conversation about critical repairs and significant deferred maintenance. And many of you in Florida in particular are looking at engineering reports. And some of you are maybe going, my God, I'm not an engineer. How the heck do I understand this? Well, we have a training that is really for the lay person, me, you, all of us, to understand engineering reports. We worked with an engineer and with Freddie Mac to develop this training. And so that is a free resource as well. And I encourage you to look at it.
Thank you. Yeah, definitely check those resources out. Closing thoughts. So mine is aim, excuse me, aim for health, not minimums. If we pursue financial health for our communities, if we focus on building financially healthy associations, then the Fannie Mae eligibility often becomes evidence that we're on the right track, or a byproduct of good reserve planning. We don't necessarily lose weight just to fit in those pants or see that number on the scale. We're really losing weight because the real goal is health. We want to live a longer, healthier life. It's the same way with these lending guidelines. It's not just so that we can be compliant. It's so that our associations can have a healthier life, really. Jody, do you have a quick closing thought before I turn it back over to Peggy to wrap us up?
Yeah, Nick, I agree. It is that long-term sustainability. And if your associations are getting reserve studies, quality reserve studies, they're following the recommendations in the studies in terms of funding plans and maintenance. You got to do both. You can't just sit on a mountain of cash. You actually have to spend that to maintain the project. Chances are you're not going to fall afoul of these eligibility requirements for Fannie Mae. So ask your associations, who do they want to be, and then do the right thing. Make sure that they are financially sound and sustainable for the long run.
That's great. Yeah, who do we want to be? So I'll put my contact info up there. We are out of time. I do see a lot of great questions in the Q&A, which do not fear. We will answer all those questions and we will email them out, I believe. Peggy, you can confirm that, but everybody can see the answers to all of those questions as well. If there's anything, if this sparked any ideas or you want to continue the conversation, please reach out to me. I'd be more than happy to help. And I will turn it back over to Peggy to close us out.
One last thing. How about Jordan? Do you have any final comments yourself, or?
No, it was all pretty great. I was monitoring the questions as they came in, and as we progressed, some of the questions that were asked a little early on ended up being answered. I think the theme of it was pretty solid. The idea that it's not just for checking a box, or as Nick put it, getting that number on the scale. The idea is that if you are invested in the property, your home, and you follow a reserve study and like Nick said, you appreciate it, you value it, and you show that, then the requirements kind of just fall in line as an after effect. But the real goal is to be financially healthy.
Absolutely. Awesome presentation, Nick and Jody. I can't thank you enough. And also want to thank you, Jordan, for moderating and and chiming in as well. Very important topic, and something that a lot of the boards are constantly discussing. I encourage any board member that's on today to take that recording, pass it around to your other fellow board members, and maybe take a look at it. And maybe even talk about having Nick or Jordan come out and talk to you maybe in a town hall meeting if everybody has questions in your community. I also want to thank the CAMs and the board members on today for choosing our webinar for today. And I just want to mention a couple of the upcoming webinars, starting with, we have none next week, but starting with August 19th, I have Tom Ingbaum coming in from First Citizens Bank. He's going to have a class for the HOA board members and CAMs that manage HOAs. It's an EH1 credit. So very important. I've been looking for this for a while. I finally found a couple of people to give this. And then I will have a follow-up with the EH2 course in early September from Tom. He's working on getting that approved right now. On August 21st, I have the Construction Summit, the number 8 series webinar coming in. This is a special project construction focused webinar series that was put together by Rudy Martin of GM Painting. He has formerly been with M2E Engineering and also has some background with Munyon Painting. So very important class. It's going to be put on by Stone Building Solutions. They're an engineering firm, and that is going to be one that you don't want to miss. But here's another one very important. On August 26th, I have Peggy Vivas coming in from Ball Janik. She's going to be giving an HR course. This one is called Mastering Connections, A Journey with Effective Communication and Emotional Intelligence. You know, this is a great course for builds property managers' emotional intelligence and communication skills, and especially working with board members. So communication is everything, in my opinion. Lastly, I'll close with mentioning a webinar we're going to have. It's not a CEU course, but in Tampa. If you're Tampa-centric, if you want to be invited, you can let me know. But in Tampa, I have the Emergency Management Team Director, John Antapasis, giving a talk for about an hour on Tampa-centric needs and necessities for preparing for hurricanes. And also guest speaker with that is Steve Mason. A lot of you may know him from Altieri. He's a former CAI president. A couple of times he's actually on the national CAI board. So look for the flyers. I cannot thank you enough again, and I look forward to seeing you on the next webinar. Have a great week. Bye-bye.
Thank you, Peggy.
Welcome.